Let's ask Chris Hyzy. He's Chief Investment Officer of U.S. Trust Company of New York. He joins me now live. Chris, gosh, starting off a conversation like this about how you take care of your money in an environment like this raises a lot of questions. When you look at signs of hope on the manufacturing front, really disappointing this morning. Are you changing any of your positions?
You know, we're not changing any positions right now. We've said for the better part of 2 years that this is a long, very long, drawn-out workout, restructuring of the entire world growth order. It sounds very, very emphatic, and it's purposely done that way because we're going to have to repair in the rich world for the better part of the next business cycle. What does that really mean? Constant deleveraging, constant paying down of liabilities, taking good productive capital that you would normally invest in things and actually paying down liabilities, and then accelerating the growth shift from the U.S. consumer to the emerging market consumer. Now, what does that mean for today? What that means today is you're going to get more cross currents in this market than we've ever seen. There's more emotion in this market than we've ever seen, many of it justified. What I would say this, you've got policy in the government side of the equation, you've got economic policy, and you've got business policy. What drives an economy is business policy and transparency around the future. We don't have a lot of it right now. Our view at U.S. Trust is as the motion gets removed from the marketplace, as you see this economic recovery take further hold at the end of the summer, you'll start to see business investment pick up, and earnings will drive this market.
Removing emotion from this marketplace really seems like a hypothetical at this point. As you've said, you know, fears begetting fear. What changes your outlook here? How do you still believe we're in a cyclical bull market here?
You know, right now, it really just depends on exact policy coming from the administration. Right now, when you talk to business owners, you talk to CEOs, et cetera, their confidence is moving up in terms of their business as it relates to the bullwhip effect, industrial production trying to match new orders that come in. They can't keep up right now. So underlying components of the economy are moving forward. But when you're talking about significant hiring, our belief is it's coming. We've been saying that for quite some time. It's getting a little concerning that the lack of transparency around policy is causing that hiring that you would normally see to kind of take a back seat. When you talk to CEOs, they're still unclear as to the tax, cap and trade, any of these other things that they would normally be fine with. It's just not there.
Yeah, well, let's hope that perhaps Friday's jobs number may break that trend. But when you look at what's happening in Europe today, Spain had a fairly successful bond sale. There were signs of hope in terms of fewer loans being asked for on that front. What still makes you apprehensive about Europe? What do you have to see to change your outlook there?
Now, when one asks about Europe, our typical response or a strategist's typical response is we don't like Europe. Actually, we like Northern Europe. We like the German manufacturing companies. We like the French luxury good retailers, precisely because they're the only area within the European continent that is going to benefit from a drastically weaker euro, even from here. But overall, Margaret, I would say on the European front, there's such a large, huge gap of yield in the world. Wherever there's yield, you will see an influx of capital on a risk-adjusted basis. They feel comfortable with that yield, they're going to buy it.
Chris, I got to leave it there. Thanks for giving us your reaction and insight. More in the markets ahead.